How you doing? This is Dave with another innovative investment idea. In today's video, we'll be going all the way back to basics to answer the question, what is a stock? But before we get started, don't forget to hit that subscribe button if you're new to my channel to get more content just like this. The term stock is often used interchangeably with two other terms mentioned within investing circles, namely equity and share, but all three ultimately refer to the same basic concept, which is the ownership of a company. To answer the question, what is a stock, it is first necessary to answer what company ownership means. In simple terms, ownership entails being financially responsible for a company, meaning there exists the option to take a percentage of the profits it generates if it is booming, and conversely, but equally as important, the obligation to take a percentage of the losses if it is not doing so well. The size of the percentages in question being directly proportional to how much of the company is owned. Let's illustrate with an example. Meet Kathy. She is the founder and CEO of an internet security company. She owns 100% of the company and is solely responsible for all her employees' wages, including herself, all the equipment such as laptops, phones, and desks, the rental cost for the office space the company occupies, the electricity, water, and maintenance costs to have everything up and running, also for paying healthcare and other benefits for her staff, and finally paying taxes on any profits the company makes after paying all the above. You can see that even in this simple example, it becomes obvious that businesses have a lot of components and moving parts to consider. Let's simplify the thought process in what might seem like a slightly odd exercise at first, but hopefully will add clarity very soon by imagining that the entirety of Kathy's company can be placed inside a cube. So the cube now represents everything we just discussed, namely the wages, the office space, equipment, taxes, and so on. Now imagine that after a while, the company is doing so well, the demand for its products and services increases by a factor of 100. They're getting sales calls from every corner of the globe, from potential customers both large and small, and the scale of the operation is escalating quickly. Kathy realizes that her current resources within the cube aren't sufficient to meet the increased demand, as she needs not only additional staff, but also more equipment and more office space, which will result in higher electricity, water, maintenance costs, and naturally higher taxes, assuming the business can capitalize on the newfound demand. All of this expansion effort and activity will cost a lot of cash up front to pay for everything, and Kathy just doesn't have the resources to do it alone. She needs help. You might suggest that she could simply borrow a large sum of money from the bank as a loan and use that to pay for the expansion. While this is certainly a valid option, keep in mind that by doing so, she commits the company to repaying the full loan amount in the future, in addition to any interest. This could spell disaster leading to potential bankruptcy if Kathy and the company don't manage to successfully grow as they anticipate. What Kathy really wants is cash to expand the business, but at the same time, also not commit the company to any future financial obligations either. This is where stocks come into play. She decides instead to divide the company into smaller but equal portions, sell some of the portions to investors, and then use the proceeds from the sale to pay for the expansion. This is beneficial for all involved. Consider that investors are happy to be on board because they see the opportunity for the growth of their investment, since Kathy has explained the massive upside, but Kathy is also happy now because she has new partners to help in her endeavor while avoiding any future obligations for herself or the company. Yes, she may have sacrificed total ownership of the company, but she has arguably an even greater chance to succeed than ever before because her company now has access to so much more resources and cash than she could have presumably managed to raise had she opted to remain on her own. In this example, let's assume Kathy splits the original company into 6 by 6 by 6 for a grand total of 216 equal parts. One of these parts represents a stock of the company. In other words, a fractional ownership of the whole thing. Hopefully, it is clearer now why we initially imagined the company as a cube, as it is easier to conceptualize a cube being divided into 216 equal parts as compared to a laptop or an office space. We should also note that 216 equal parts does not necessarily mean 216 individual investors either. An investor can potentially purchase multiple shares, giving them a greater percentage of ownership of a company. As we can see, Kathy still holds a 50% ownership stake of the company, while the others hold the remaining for a combined 50%. Now, if a year later, the company manages to secure $100,000 in profit, for example, it could be possible that the company decides to give money back to the investors based on their percentage ownership. This is what is known as a dividend. The choice of whether a company awards a dividend to its stockholders is determined by the CEO and other people who run and manage a company, and depends largely on how they assess the best use of the cash the business has accumulated or has access to. In some instances, if they instead believe that they can grow the company even further to produce even higher profits moving forward, they can keep the money as retained earnings, which can then be spent on things such as new research and development, or even acquire smaller companies that provide synergy or enhance the existing business. Finally, companies can certainly remain private if the stockholders are happy with the arrangement and are able to continue and expand the operation of the company moving forward without any additional help. However, in many cases, companies want access to even more capital and expand more aggressively, so they bring in even more stockholders. This is essentially what happens when a company goes through an initial public offering or IPO, where it offers members of the general public a chance to invest. As a result of an IPO, companies will tend to have millions if not billions of stock outstanding and become tradable on large exchanges such as the New York Stock Exchange or the Nasdaq, which are accessible by billions all over the world. The stocks in circulation on the market will change hands between buyers and sellers hundreds if not thousands of times, and unlike in our example with Kathy, no one person gets to determine the price, but rather it will go up and down each trading day because every investor will have a different opinion or perspective of what price point they are willing to become a stockholder and at what price they are willing to give up their ownership in exchange for money instead, based on their personal valuation of a company. News about the company or the economy at large, either good or bad, can also dictate the company's perception on the market and in turn affect investor mood and ultimately the price as well. That about wraps it up for this video. If you enjoyed or found it helpful, please hit the like button and drop any other questions, thoughts or comments down below. You can also click on any of these 4 videos here and learn more about the stock market. As always, thanks for watching and I'll see you in the next one.